Hey everyone, it's Mike Bonn with the Cash Flow Company. Today we're going to continue the series on making your real estate investment career, your business, an E.L.F.F business. Easy, lucrative, fun, and fast. I want to walk you through how credit score impacts even your DSCR. Our focus here is how to set you up quickly so you win, make it easy for you, make it easy for your lenders, just make real estate investing easier. If you focus that real estate investing over the next few years can create the generational wealth and the income you need to live the life you want, then this focus is definitely for you because we want to make sure it is that. It is easy, it is lucrative, and in 3 to 5 years, you're in a point where you can make life changes, make life easier, whatever you want to do. Maybe it's still staying in the investing world. Part of that is remembering leverage is what creates an equal playing field for everyone. Real estate investing is all about using other people's money to create wealth and income for yourself. They get money, they get interest, you create the wealth by creating value-add properties, rental properties, dividing land, whatever it may be. But it all comes down to leverage. Leverage is king. Leverage is the funding, the money, the loans, using other people's money to create the wealth. As we went through before, in this day and age, credit scores matter, is part of your tools. Credit scores and money buckets, meaning how much you bring to the table in either down payment or reserves or just showing you know what you do. So credit and money buckets are very valuable. And if you set them up correctly, if you set it up from the beginning, or when you're in it, set it up now as fast as you can to make sure you win at this game. There's no other point in time in history where credit scores matter more for a company that relies on leverage. Sometimes we don't want to hear that. Sometimes we want to do it. But the people who do, it's an advantage. It'll be an unfair advantage, really, as you take advantage of setting this up correctly. Making sure you have your entity set up correctly. Make sure you have your buckets of money, credit cards, 0% credit cards, business credit cards, HELOCs, OPM, all those things that also impact you as long as your credit score. We're going through different examples of showing you exactly how this impacts you, how it makes it easier for certain people to get that E.L.F. business going and actually having fun at this compared to others who struggle. So today's example, I want to walk you through how credit score impacts even your DSCR. If you could qualify for a payment or you get kicked out of underwriting and you can't get the property because you've gone over or under the DSCR. Remember what DSCR is. It is an investor-friendly loan that is only based on breaking even on a property where you have on one side your rents, on the other side you have the 5 things: your payments, taxes, insurance, and HOA, and flood insurance if you have it. So let's go through an example of why credit matters, why it should be in your toolbox to make sure it is easier for you. Now we're just going to take a property. It's a 3-bedroom, 2-bath, rent's nice, rents are $2,500. Make this easy just for our numbers. We're going to say taxes are $200 and insurance are $200. So at the end of the day, what the underwriters, what everyone's looking for is you to qualify or to not have your payments above the $2,100. That's the $2,500 in rent, minus $200 in taxes, and minus $200 in insurance. Remember, in this example, we're not going to go over HOA and flood insurance. We're just keeping this simple. So your max payment to get to a DSCR of 1, which is break even, is $2,100. Now let's use 2 different examples of real estate investors. They're both qualifying for a loan of $275,000, but one is taking responsibility. They've taken care of their credit, they monitor it, they watch it, and their credit score is 760. So their tool, their credit score, is helping them out. So with this example, if you had a credit score of 760, you get a rate of 8.25. Put it in calculator.net, wherever it may be, you find out that 275 at 8.25 magically comes out with a payment that's under $2,100. So you qualify. So the underwriter looks at this and gives you the okay to move forward to get the refinance. But let's say that's the same property. Everything's the same. But an investor uses their credit cards, their personal credit cards, drives down their score. They're making payments on time, but they've done a few things that impacted their score, and it then impacts what they could do or how they could fund projects. The same property with investor number 2 that has a score of 680. Not horrible, just not where the lenders want it. So they get an interest rate that's 9%. So that 9%, what it does on that $275,000 loan is it increases their payment over the threshold, which was $2,100. Their payment now comes in at $2,212. So as you see, the same mortgage, Two different investors, the only thing that changed was their credit score. One gets approved for a loan because their payments meet underwriting guidelines because it's under $2,100. The other person, their interest rate was 0.75 higher because they just didn't take care of their credit, kicks their payment above the threshold, the 2,100, and now they are not qualified. They cannot get a loan to refinance, and they're either going to have to sell the property or keep their loan or whatever it is, but they just had a disadvantage. The person with the better score made it easier, made it quicker. Granted, this person who was declined could pay money down, make the loan smaller so they do qualify, but there's another hurdle. Now they have to have that money. Now every property they get involved in, they're putting more money in than the person with the better credit score. Credit scores matter in this environment. Credit scores make it easier for you to either qualify for a refinance, put less money down on a property, increase your cash flow. All of these things come back to one tool, and this tool we're talking about is credit scores. Credit scores are something you need to take serious to make this an E.L.F. business. Remember, easy, lucrative, fun, but fast. Just to give a shout out, Joe Polish came up with E.L.F. easy, lucrative, fun. We've just added fast because that's what we want. We want you in 3 to 5 years to create this generational wealth or income. If you're new to this business, you have to set up correctly, from how you set up your business, how you set up your accounts, your bank accounts, all those things. How you make sure from day one you're using business credit cards instead of personal credit cards. How you're creating a bucket of money for yourself from other people's money who have money, they just want a better interest rate. How do you set this up to win? Or if you're into investing and you've maxed out your credit cards, or your credit cards are at a point where it's hurting your credit score and you can't get that loan, you can't get that property, you have to miss out on a flip that comes up just because you cannot qualify for a loan that gets you into that property. This is all about making your life easier, making the lender's life easier, and making more money. If you're a new investor, how to make sure you set it up right from the beginning, or you're an investor that's out there, working a daily, but your credit score or your money buckets are not helping you, check the link below. We're here to help you. We want to make sure we put you on a right path with a systematic program to get you there, because it makes it cheaper for you, easier for you, and it's actually easier for the lenders too. Check the link below, and we'll see you on the next video.